Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name is Seth Crossman. Ben Brayshaw and Dan Mickelin are in the house. Good morning to you guys. How are you?
I'm doing good, Seth. I'm doing good. I know Dan's doing good. I just talked to him a second ago. He seems well today. A little peaked. Yeah, a little peaked. But he seems okay. Seems okay. He's doing good.
That's my general fall hue. You know, it's just kind of the sun fades quickly for me and get into that winter state. But yeah, no, it's good. I'm excited for the show as always. I think we get a lot of good information for everybody. This is an important topic. You know, other than Social Security, this is the one investment that, or potential retirement tool that essentially we all have, right? Or most of us.
This show today is 401k no more. It's the truth, people. You're really going to want to tune in if you have a 401k. Like many people that are in transition around our lovely economy or the states these days, or even, people that are repatriatizing. Those are options that are on the table for them. And if it's an unfamiliar topic, it's one that we're going to get intimate with today. I'm looking forward to it. That's the temperature in the room here today, is we're going to have a good time and can't wait to get into this show with you.
I think we're going to scratch the back of a few people that they're going to say, you know what, that makes a lot of sense. And I hadn't thought about it that way. We're kind of going upstream here like a salmon up water. I mean, I think there's going to be a lot of people aren't going to like what we have to say, but there's some real truth to kind of uncovering the transparency in a 401k and, what you can do, should do, and how you're getting mistreated and how you're getting fairly treated, and kind of working through those pieces. I think it's going to be interesting. I think a lot of people are going to have their eyes open to stuff that they're going to be pretty upset about, honestly. And some stuff they're going to be like, you know what, I'm going to take care of this problem. I'm going to get it resolved. This is what this show is all about, is helping people, make better decisions. So I hope that gets someone to the right crossroads and helps them make the right direction turn at that point.
Well, I already don't like what you have to say, Ben, but I'm going to believe that there is a silver lining in this for all of us today. So let's make it happen. You're listening to Money on Tap, and now it's time for Money in the News.
Coming to us first today from Reuters, Honda and GM scrapped $5 billion plan to co-develop cheaper EVs. And I think this article, points out one example of a larger trend throughout the auto industry, is that, EV sales, particularly in kind of the lower end, more affordable end of the market, just simply aren't as robust as they expected, with all the pressure from the government and the rebates and all the opportunities that are being presented to us as incentives to get into the electric vehicle. It's just not resonating quite as strongly as the automakers had hoped. Again, particularly in the kind of the more affordable end of that market space. And Honda and GM had engaged in a partnership a couple of years ago to make obviously this heavy $5 billion investment to jointly develop cars for that end of the market. And before they've even rolled the first one off the assembly line, they're pulling the plug on it. It just has not panned out.
No pun intended.
That's true. Yeah, it's not forecast to be the marketplace that they thought it was. And obviously we have the strike thrown in there. The auto workers strike is not helping the situation. But I believe that's come to an end, as we speak here. But anyway, for those of you who had eyes on a more affordable EV upcoming, might need to change those plans.
Yeah, and I don't know if you planned the pulling the plug thing, but that was fantastic. I mean, that was probably the best one line I've heard in a long time. This scenario is the culmination of corporate America making a very wise business decision. People are two things. One is people who want EVs. Yeah, they want a cheaper one, but the problem is there's not enough. We've done show after show on talking about EVs. There's not enough places to plug these things in. You got to wait 30 minutes to an hour sometimes to charge the vehicle. People are getting stranded. people don't want EVs yet when they realize, hey, I can't really facilitate a proper transportation system. There's not enough infrastructure to underline the use of a straight EV. Hybrids, yeah, we can do that. But a straight EV, and then the call for all the things the government in California, for 2035, no more gasoline cars sold and all this stuff. I mean, we do not have the ability to get there yet. And, GM and Honda backing out of this thing only delays the ability to create the actual vehicles to be purchased to match the has to happen governmental requirement here.
Yeah, I'm not too surprised. I mean, on the shift here with what they're talking about is just basically trying to use the GM's Ultium battery technology and the platform, just not necessarily working out towards a lower cost vehicle. But, resetting their target towards 2024 to have a driverless service and that venture with GM and Cruise being really still online. This is just kind of a common practice in the industry to, explore the opportunities, announce things and, get down the road and say, well, that clearly isn't going to work. And I think in terms of a technology that's still pretty new, trying to get the platforms to agree or align is just part of the process. And we've seen a lot of this stuff in the past where they've just had joint ventures across the board, you name it. The chassis was from one company and, the trim was from another, and the title or the label on the car equaled, Honda or whatever your manufacturer was on this. But don't get too discouraged. You're still going to have a lot of opportunities here to buy Honda EV if you want. They're saying they're going to go, completely EV by 2040. Again, that's just all so far down the road that set a target, set a date, make a headline. That's what it is.
And next up is Jamie Dimon says central banks got forecast 100% dead wrong, and it doesn't matter if the Fed hikes rates again. This is coming to us from Shannon Thaler. And, this article, Jamie Dimon, first off, is very much outspoken CEO, and he makes headlines all the time with his, various statements. And he seems to be generally, aware and on point. But the point of his article here is something that, essentially affects us all. And what he's saying is that the Fed has so continuously gotten their forecasting wrong, and he's lost all faith in the notion that by raising rates along the track that we have, even though there's been several pauses in that regime lately, none of it's having the effect that they expected it to have. So essentially, one, why trust them going forward? And two, why should they even bother? Because the pressure they're putting on the rate world is not impacting our economy as a whole in the way that they expect it to. We are just spending our way straight through that, and inflation remains sticky, far from transient. And these kind of small increases in rate hikes, they're just hitting the sector of the economy, the people that essentially live check to check and aren't on the more affluent end of the scale. Those are the people being affected, but the economy as a whole is just plowing right through this.
I think the Fed is probably one of the most disappointing organizations across the board. I think they're manipulated politically. I think they're manipulated personally. I think they have a vested interest in a lot of this stuff. Maybe I am a massive conspiracy theorist on this stuff. I really don't think that they have our best interests at heart. I think when we're going through some of the hardest times, they're, seem to be driving a wedge through this stuff. But I think at the same time, Jamie Dimon might make a valid point that, all the things that they're calling for really maybe aren't relevant. Maybe the taglines, when we talked about the Fed raising rates and the fact that some of our enemies like China are, lowering rates during this time period, it's kind of shocking to me. Why would they have it completely different and, empowering their economy, and yet we are trying to drive a wedge in it, and yet we're, spending's still there. Looking at earnings, I don't know about you guys, but even just the last few days, company after company is exceeding their earnings. It's pretty phenomenal, and yet, the market's been pulling back, and I look at the opportunity for some of these, dividend assets out there, and I'm just saying to myself, wow, I don't necessarily. You're never going to buy at the low. You're never going to sell at the high, and I think you got to be happy with what you purchase. It's like, I talked about when you buy something before Christmas for a friend or a family member. Yeah, it's going to be on sale in 2 weeks or 3 weeks when Christmas is over, but you're happy with the price you paid. And I think that's the way you have to look at stocks sometimes. And I think, this is really interesting when you really start thinking about, hey, how is the market, the economy actually doing compared to their stuff? And what is the Fed doing? Why are they raising rates? Why are they going through this process? What is the underlying motive? And that's kind of why the conspiracy theorist in me gets alarmed. I don't know. That's where I run. I'm not going to be apologetic for it.
Well, U.S. economy grew at 4.9% pace last quarter. That's the fastest since 2021. So what do you do with information like that? How much has the Fed actually done to slow any of it down? Or, really, what effect do they have? And I completely agree with you. And Jamie, I just, we've had the conversation many times here around the Fed and, what really is their role? Are they out there? They're out there to try to create joblessness, and that's the indicator that they're looking for. No, they're out there and they're trying to see the market pull back to a certain point, and that's the indicator. Frankly, I don't even think they know what their job is, but
I don't think they communicate it intentionally. I think they intentionally avoid it and they throw out other things. But when I think about rates going up, I don't know about you guys. I don't know about all of our listeners, but if you're listening today, wealthy people can buy houses in cash. Like, they have assets. They just buy in cash. They're not worried about interest rates for the most part. Okay. Like the super wealthy, they just lay out the money and they buy it. The interest rates affect the small guy. The interest rates on a 30-year mortgage are what you, me, and every one of our listeners is worried about. Those are the people we need to be helping. Those are the people we should be empowering. Those are the people we need to keep moving because they drive our economy. The small business owner that needs to borrow money on a credit card, to buy plumbing supplies or wire or, stuff. I mean, they don't need to be paying 25, 20, whatever the percentage rate is. Like, they need to get better rates so they can continue running their business in a healthy way so that they have more profit to buy food for their family. It's that basic. And anyone who wants to try to overcomplicate it just really doesn't care. Like, they're not thinking about everyone around us and what we have to accomplish. That's why I think tax planning for Americans is so important, because that's the only way we can actually create an alternative advantage against some of this garbage that's going on.
Wow.
You just opened up a whole nother can there for me, Ben. I was like, wow, what if we went to a tiered system on rates? It's, qualify for certain rates based off of income or something like that. Kind of like our tax system has been working in the opposite of that. So up next, we have AI. This is a lovely topic. AI is driving divergent paths for big tech stocks. Thank you, Josh Schaefer. And this is Yahoo Finance, Alphabet, or Google, and Microsoft stocks are headed in opposite directions after reporting earnings on Tuesday night. So on the surface here, Microsoft has been able to turn a profit out of their AI into the cloud. And Alphabet has been disappointing. It's so interesting. Do I see Alphabet actually not recovering from anything like this, or not being able to turn around and kind of spin this in a profitable direction? No. Very much the opposite. It's just it's an interesting first leg in the competition out here in this AI world, to see what are two of these behemoths doing in the AI world, and how are they turning this into, dollars and cents for their stockholders. Maybe that's too.
Yeah, I think this is interesting that, for a long time, at the beginning of the year, right, first half of the year anyway, hands down, anything tech or AI was just absolutely skyrocketing. I mean, we were getting phone calls, I know I was, for people who are novice investors at best, and they're like, I want to buy AI. It's like, well, do you even know what AI is? Nope, but I want to buy it. Right, let's get it now, fast. So it didn't matter if you had any affiliation with AI or tech or, anything in the NASDAQ for that matter. You just buy the index, and it was a great time, right? I think this is the first major indicator, at least amongst like the super mega caps, right, that there's some discernment finally coming into the market about, well, who's actually doing well with this stuff? Is anybody making any money out there? And, I think Alphabet, Google's a great company, right? This is probably one of those buy the dip opportunities, right? But not that that's specific advice for anybody listening. But yeah, I like the fact that finally there's somebody taking some degree of evaluation amongst the contenders and the players in this space, and just it isn't just a frenzy to buy.
Dan, I would tell you that we have had a plethora of phone calls on AI. I mean, we have had I had one tech guy say, I want to buy every traded AI company. I want to put a certain amount of money in it. I was like, okay. And so, we've researched it, but there's not a lot of AI companies that are trading on the exchange. I think that's what a lot of people don't realize. They're all private companies. There's money flying around New York City, private equity, venture capitalists looking to invest in anybody who can use the word AI. And, if you can spell it, you can raise money on it. I mean, that's really everything I've heard and read. The thing that I think that a lot of people aren't really taking into play in their calculations on investing in AI is that Apple, Google, these companies, Microsoft, they're building their own AI. They don't care about a third party. We're wealthy enough.
Just stealing it from the third party.
Yeah, or stealing it because, hey, we had a patent person that Google totally ramrodded. These companies don't play fair, and that's one of those things. And so I think when you really go through what AI is and how to invest in it, you could get burned just looking at third-party companies because they're only going to service the small guy who needs something. But the big players in AI who are going to deliver the AI experience we're talking about are going to be Google, Apple, Microsoft. It's going to be one of those massive players when they build their own, and it just is the AI, and everyone has to have it. They're chasing AI because they will become the pinnacle company whoever wins this battle. If Google wins the AI battle, everyone will have a Google phone. If Apple wins the AI battle, everyone's going to have an Apple phone. That's literally probably how this thing plays out, and I don't think people are quantifying all the aspects of what people are chasing with AI. So my thoughts, interesting area to invest in. Buyer beware, you're going to lose a lot of money if you invest in all of them.
Anybody looking at charts or wants to take a look, this is one of the most interesting ones I've seen in quite a while. The 6 months chart on Microsoft versus Alphabet. Back in early July or late July, they were trading at the same point. And Google, the divergence was almost an opposite of what is happening now, where Google split off and headed north and Microsoft headed south. And now it's like there's a complete shift, like where there's a gap up and a gap down, and Google coming back down almost 20% and Microsoft up around 15%. And they're almost back at the same levels that they were in late July. So really fun chart to take a look at. You're listening to Money on Tap, and you can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about 401k no more. This is not your typical 401k show. We've done none of our shows are typical. I'm not going to say that. All of our shows are just outstanding. So if you're looking through the catalog of nearly 300 shows that we've done here at Money on Tap, you're going to get into some meat, and all of it's going to be valuable. Right now, what's going on, we're going to talk about specifically right now what's happening inside of the 401k world, your 401k, or maybe the 401k you're about to sign up for, what you need to know, what you can do with some of those previous assets, and how you can get your financial plan and that retirement plan on track. Keep it on track and not become, one of the numbers out there of people that are going to say hindsight 2020, wish we would have done something back then. Nope, you can be ahead of the curve by sticking around here. You're listening to Money on Tap. Again, thank you for our podcast subscribers. Don't want to forget you. If that's you and you've subscribed and you send us a little a love letter at info@yourmoneyontap.com. You can send those to Ben. You can send your hate mail to me. Same address. That's fine. I'll receive it, and we'll send you, no matter what, we'll send you out some Money on Tap drip and or gear for those of you that are wondering what in the world he's talking about. Yeah, we'll send you some Money on Tap gear just to thank you for dropping by, subscribing, and being a part of us here at Money on Tap. We'll be right back.
Are you looking for personalized guidance to kickstart your investing journey? Look no further. Brayshaw Financial Group and our planners are here to help. Our team of experts will provide personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today to schedule your free consultation. Brayshaw Financial, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are going to get into this with you here today. It's our 401k No More show, and that leaves a lot of questions on the table. What are they talking about? Are the 401ks going away? No, that's not what we're talking about when we say 401k No More. And the 401ks are not over, and there's still an opportunity. And we're as before we said, we're going to get intimate in this topic with you. A lot of the time inside of the 401k conversation, there's the some of the history of where these 401ks have come from, or what are some of the new regulations that are coming down the pipe. And, there's just been a lot that's happened inside of this conversation. What we're going to be talking about today are what are the allocations that you've traditionally held inside of a 401k, some of those expectations as you're growing your retirement asset, given the current circumstances or the landscape that we're in. What are some things that we can be looking at for you right now? And also, what are the opportunities? What are some of the tax advantage opportunities? This is a tax advantage kind of an account for you. And you know what? I take that back. I roll that back. All that stuff that I just said, I am going to go ahead and talk about some of the basics of 401k. Like, how can we do a 401k show and just not talk about like how they work, what they are for a quick minute? Okay. So roll that back. So 401k contributions, right? These are contributions that you can put into your 401k. Normally there's an employer match inside of that, 3% or something like that. And in planning, we like to talk about free money. Always number one for planning, let's get some free money. You got it? Look good. Let's go get it. And you make your contribution, employer matches that contribution, 3%, 5%, whatever the plan allows. And you can contribute up to $22,500 or $30,000 if you're 50 or older. That's called a catch-up contribution. Okay. And so inside of that, those are monies that come out of your pay that's taxable and go into the 401k. And then it's not taxable until later on when you roll it out or you start taking your distributions, and it's ordinary income at that point. So that's the basics of this. Now, those inside of the 401k, they're going to give you what we call a lineup. At least that's what we like to call it in financial planning ease, our little language that we speak over here. You've got an investment lineup, and you get to choose, or if you don't, they'll choose for you. They have to by law. And so they'll decide based off of your age what's appropriate for you. And it's kind of like an estate plan, right? You have one, you just don't realize it until, you're gone. Then the state takes over and does your planning for you. Well, they're going to do that for you in a 401k. And so what we're going to talk about is what's been very typical inside the 401k is an allocation that's been kind of pre-selected sometimes, or you've selected it because it's what everybody in the industry has said is, a good allocation to have. And we call that a 60-40. That's kind of been that stalwart out there of like, hey, you can't miss if you do a 60-40 allocation. 60% into equities, or equities are stocks, the market. 40% into bonds. And that has been kind of the ATV, or the altering vehicle in this market. And so that's going to be kind of some of the stuff that we're going to be talking about first and foremost when we're in this conversation of 401k, set it and forget it, no more. Some things just get different, and we've got to be prepared. We're here to prepare you for different. You don't have to sit there. You don't have to sit there and just take whatever they give you. All right.
Seth, I love the lineup phrase. It's kind of like for all our fantasy football, we're in football season, fantasy football players, like, you choose, your quarterback from this team and your wide receiver from that team and your running back from here and the defense, and they're all different teams and so forth. And you get to your 401k and it's like, I've got this lineup of people, and you know what? I don't even watch football. Like, there's tons of people out there that, love sports, but there's a lot of people who don't know anything about it. And you know what? There's even more people that feel more vulnerable and concerned about knowing investments. And I think that's kind of how I see it, as the person who says, hey, I've got to pick my fantasy football lineup here for my 401k portfolio. I know nothing about finances. And honestly, I have to depend my whole future on this decision. I mean, it's massive.
Also, inside of that lineup, what if, okay, I love the fantasy analogy. What if you went to go pick your players and they changed all the names?
Oh, yeah, that happens too. All of a sudden, it's an interesting concept of the lineup piece, because I think people feel so vulnerable and so scared. They pick these things. They call somebody on an 800 number. They'll never talk to that person again. They tell them to pick, some target date fund that says they're going to retire in 2035 or 2030. And, they're like, well, I don't know. I mean, that's what they told me to do. And meanwhile, they have no idea that they're paying excessive fees on these target date systems versus actually buying the version of mutual funds underneath those. And if you don't know what we're talking about, give us a call. I mean, there's no reason to overpay fees for some of this stuff. And secondly, they don't know when to change anything, because honestly, they don't know why they picked what they picked to begin with, right? So it's like, oh, goodness gracious, my wide receiver is so-and-so, and I'm going to change him for this other person, but I honestly have no idea which one can actually catch the ball. And that's the biggest problem we have is really trying to figure out how to get our portfolios in something that's going to make us money.
I think the hard part is
that's where people are struggling. Go ahead, Dan.
Sorry, man. So I think the hard part is for people, fearing, looking at retirement upcoming, is that there have been periods of time where you could have done the set it and forget it approach, right? There's been long swaths of time that the 60-40 portfolio just performed. So people were able to sock money away into the 401k and watch year by year as the statement, seemed to, consistently and continuously just go up and up and up, and required very little management from them. But that hasn't always been the case, right? So this is the important perspective that we need to apply to, looking back at history and then trying to forecast that forward into our future. And the underlying condition here, or issue, is that we're experiencing some things in our economy today now that are similar to times in the past. And the result that played through into a 60-40 portfolio was not great news for investors before. And what the chances that set of conditions is going to deliver the same result again, and how do we best prepare for that?
Yeah, I think you're right, Dan. I think there's just so many pieces of history that show this works or that works, and no one knows what to do. And I think we want to dive a little bit into that as we kind of work through this piece. One of the complications, so when we talk about 60-40, as Seth had mentioned, there's 60%, kind of that equity space, which is like our stocks. Like we could talk about stocks, and we could say you own the company of Exxon or Chevron or I don't know, Microsoft. Those are stocks, okay? And then you can have the bonds where you lend companies money, okay? And you can lend money to a Microsoft and buy their bond, and you'll just get whatever you deposited back plus interest, assuming the bond doesn't fail. And so that being said, people usually have 60-40, meaning 60% equities or stocks and then 40% bonds. Now, bonds are considered safer, but for the last decade or so, bonds have been horrendously horrible in a portfolio. They have been the anchor dragging behind your boat. If you've listened to this show many times, you've heard that phrase, because the actual yield, the money you get every year for owning the bond, was so inconsequential. It was so low. It was so poor. It couldn't even cover some of the fees of what you owned. And it was really like a place, I mean, you might as well have your money in cash. I mean, sometimes that was really where your money was more valuable, except for you're going back against inflation. So that being said, there's all this history that goes back to quite a period of time. And I'm going to jump into this, guys. If you were to look at a 60-40 portfolio and you were to start back in the early 80s and come to 2020, just before COVID, if you put $1,000 in that, it's estimated to be worth $18,000, almost $19,000. It's an absolute incredible chart of like almost a straight up view. But if you were to take, 20 years before that, okay, from 1960 to 1980s, you're looking at $1,000 being worth like less than $800, you would have lost 23% of your money. And I think it's really hard to understand that these portfolios were exactly designed the exact same way, and just here a short period of time has just absolutely trampled a 60-40 portfolio. And then you have to start saying to yourself, okay, well, what created that story? What failed there? And when you look at the 1960s to the 1980s, you'll look at that stocks didn't do a whole heck of a lot. And yet from the 80s on, we had really great years of stocks and we had really bad years of stocks. But at the end of the day, we've said, hey, listen, baby boomers who have been going through since the 80s, investing their funds and pouring more money into stocks, buying more stocks, it's been forcing that market up as people saved and saved and saved and saved. Okay. And we have poured more money into the stock market, which makes things more valuable. People are buying more. The country's growing. And the question is, we have the Fed doing all sorts of crazy stuff right now that people are saying, are we going to go through another 20-year flat stock market? And if that's the case, does that mean if you're walking into retirement in a few years or tomorrow even, and we go through a flat decade, are you going to lose 20% of your money over the next 10, 20 years and separate from the distributions and the income you need? That's the big question today.
I think some of the symptoms that created that environment, right, were things like high inflation and an overvaluing of the stock market. Those are things that were happening in the 70s, which were right in the middle of that 1965 to 1982 time span that Ben was talking about, that really pulled all the returns out of the market. So when you understand those things and you kind of contrast that to where we stand today, another environment where we have high inflation, high gas prices, some people consider the market to be significantly overvalued, so with those things being unknown, looking forward from where we stand today, are we going to suffer that same fate? Or is something about the market that we're in today different than what it was back then? And I would say, my take on it is I don't think it is necessarily the same doom and gloom picture, but you'd be best off taking a cautious approach. And more to the point of the show, you need to manage your money. This notion of just plugging it in and sticking into that 60-40 portfolio and just taking the ride is something that I think would be a foolish approach.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Before we head off into this next break, I do want to just take a minute to thank the subscribers. It's one of those things that helps us at Money on Tap. And honestly, it gets the Money on Tap podcast to more people when you subscribe, or even better, you write a review. If you do either of those, please let us know. Send us an email at info@yourmoneyontap.com. We want to thank you and send you some Money on Tap gear. All right, we're going to take a quick break. We'll be right back with more Money on Tap.
Hello, everyone. This is Dan Mickle of Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors are here to help. Our team of experts will provide you personalized advice tailored to your financial goals. Visit us at BrayshawFinancial.com today and schedule your free consultation. Brayshaw Financial, investing made easy.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about the 401k no more, or as we were talking about, set it and forget it no more. And Dan, where you left off really, actually kind of brought up an emotional conversation. A lot of the time what we're talking about inside of these are very emotional parts and pieces. The big fear that we have out there as we take a look at the market is, a 2000, an 08, where we're just seeing the market completely dismantled. And we're very aware. And we've talked about that, a lot. And, those were conversations that we've been having for the last 10 years because, after 08, it was a very real part of, retirement fears. And a lot of people could not retire. And what we're talking about today is a little different. That was a very quick, sudden death. There was like, oh, there's no way around it. The market's 50% of what it was a year ago. This is a very different kind of challenge to move through inside of your retirement. And part of that is an opportunity as well. As always, whenever we see challenges, there's opportunities. For you, what's important is that absorb as much of this as you can. It's beautiful. You can take a podcast with you, right? You don't have to sit down with us in our office and try to figure it all out on the spot and then try to have that conversation with the people around you that love and care about you and translate all that. Here, we've got it for you. Have this conversation. Bring it back to us. Have more questions. Let's get going. It also isn't a sudden, abrupt change. So we've got some time to try to figure out what you have. Let's go through the levers. We're not in a free fall in the market at this moment. So this is pretty cool stuff.
I think when you're talking about all the stuff that's happened in the history, Seth, we talk about this stuff all the time. I dream finances. Like, this is what I love doing. I love talking about numbers. I love going through this information and digging through the data. I mean, how many times have we sat down with somebody and they say, you remember when I used to get a 15% annual CD? Like, where is that? As if that's like some sort of standard and now a new return standard that exists for everybody. And listen, the world is constantly changing, and you have to really compare what the world's doing now and what it did then, and then how it compares and how it's different. Back in the 80s when people were getting crazy, in early 70s even too, crazy interest rates on their CDs and so forth, the Fed was jacking rates. The rates have to be high for you to get those type of returns. But the thing is that's wonderful when you're investing money, but it's horrible when you need to borrow money. And right now, people are like, wow, the Fed's really, really, really raising rates. And the last time the Fed had rates this high, it was 2007. And that's why the world is super concerned. Everyone's concerned, are we going to hit another 2008? And, that question's asked to us pretty regularly. And we invest money on a daily basis. We're trading investments every day. There's a lot going on. But, if I were to look at a bar chart for the Fed rates for the last 60, 70, 80 years, which I'm looking at right now on my screen as we do this podcast, I would say that the vast majority of the time we're at or below the norm of what the Fed rates are. Like, this is not a high rate. And I think we'd be foolish to think that the Fed's not looking at the same chart we are, saying our economy can absorb a lot more. It used to be 19% in the overnight rate, and we're only at a little over 5%. Where is our perspective that it can't go up anymore? Like, where is that lost? Are we going to be looking at 15% CDs? Well, if they are, there's going to be a really top investment for everybody. People are considering CDs left and right. I have people call me, hey, what's your money market rate? What kind of tradable CDs can you get? We do CDs here. So those are all sorts of different conversations that we have. And we need to look at the differences of today versus then and how it may or may not be the same or how it is exactly going to be opposite. I know when we've talked about this, guys, we've chatted about how COVID has completely set up a crazy, I would say it's like a tornado coming through still. I mean, I was looking to buy some new appliances and my wife and I were looking around and we were like, oh, well, this is a nice one. And you know what? Well, that one you can't get till July of 2024. And I was like, July of 2024? I was like, COVID's over. Right? Hey, COVID's over, Seth.
We had one of those glass top stoves that, and we've got the, the pot rack up above it. Oh shoot! I want to blame it on one of the kids. Dropped one of the pots on the glass top and it broke. So we were down to like cooking on 2 burners. I felt like I was back in college. It took us 6 months to get a stove. I was like, what is going on? This is crazy, but it's still there. It's still happening like that.
Yeah, I don't think people understand that the COVID delay is still here, and the pent-up demand is massive. And Jamie Dimon, the article we talked about earlier in the show, he references consumer spending and the labor market are still astronomically, high. Like there's a major problem finding people to still work. It's a little bit better, but it's not better. And people are spending money left and right. And that's because our government printed $14 trillion.
And that's another one of the big differences, right? The last time we had to rely on the Fed to kind of kill the economy to stay off inflation, you made the point, Ben, 1981, they moved the Fed rate to 19%, right? And then Jamie Dimon earlier was saying, well, these quarter-point moves we're making in the 5% neighborhood are just not nearly enough. The Fed's crazy. Their forecasting's off. This isn't going to stifle the economy in any kind of way. It's just going to kind of hurt the little consumer who is living check to check and doesn't want to borrow money. They're just trying to make ends meet. So, I think that point, really matches up well with the conversation today. What are you going to do if the Fed can't handle this issue, or if they're way off, or if the only way that they can possibly get a handle on inflation is to jack rates to 19% again, which I don't believe is happening. But that's the kind of drastic difference between where we've had to rely on the Fed to do it before and when it actually worked versus what's happening now.
And so as we're talking about this, Dan, it's like, well, what does this have to do with the 401k? Like, why are we having this conversation? And the reason we're having this conversation is because if with the rates going up this high, are we going to look at a stagnant stock market for the next decade or two? And if you're a retiree and you're trying to figure out how do I create value over a flat or negative market in my retirement plan that I need to have grow over the next few years or whatever until I retire, or I'm in retirement and I can't have this not grow, how do you mitigate this problem? How do you deal with this? And nobody's addressing this conversation. Like if you haven't figured out what you're going to do if the stock market's flat or negative for the next 10 years, you need to call somebody. And what we're going to talk about as we go into this is, what do you do now? Like, how do you deal with this? So, one of the things is you have to first have to evaluate your 401k. Is it a competent plan? Is that where I want to have my money? Is that exactly how we want and how I'm going to get to where I need to be? That's up next.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about 401k no more. And when we get back, we're going to get into what you do now. Don't go anywhere. We'll be right back. Hey guys, Seth Cressman with Brayshaw Financial Group. Are you ready to take control of your financial future? Look no further than Brayshaw Financial Group. Our team of experienced advisors is dedicated to helping beginners like you build wealth through smart investing strategies. Visit BrayshawFinancial.com today and start your journey towards financial independence. Brayshaw Financial Group, your partner in wealth creation.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Again, want to thank you for going out and subscribing to the podcast Money on Tap. And if you would, do us a solid. Leave us a review. Just a quick little love letter would be awesome. That helps us out. That helps us get Money on Tap in the podcast world a little more recognition and just brings it to more of an audience. And when you do that, we're going to send you some Money on Tap gear. Send us a hello, who you are, and some way that we can get back to you. And we'll send you some Money on Tap gear if you do that at info@yourmoneyontap.com. We are talking about the 401k no more, the dilemma that we're at with the allocation inside of the 401k or the options inside of the 401k even. That's what we're going to dive into a little bit here, because most of the time when people are signing up for the 401k, I'd say probably 90% of the time, we find that they don't know what to put their money into. And so they ask the question, when would you like to retire? And you say, well, next year. That's my plan, right? I'm here for one more year and I'm out. Well, okay. So seriously, people do want to retire earlier most of the time. And so they put that date in there. And what happens in that 401k is they make a recommendation for what's called a target date fund. Now that may not align with where you're at in your progress towards your retirement goal. All right. It's not a genie in the bottle that says, so be it, pick the date and that's what happens. What it's trying to figure out is what a proper allocation for you based off that timeline is. Because if you've got 20 years left before you retire, that target date and the allocation is going to be more heavily in the equities or stocks side. And as you get closer towards your target date, it's going to shift closer to bonds, which guess what? If you've been paying attention, bonds have not done well until lately. And we're talking about a long period of time that bonds have not done well. And that was brutal for people trying to retire, thinking this fund was going to do the job for them. We're going to talk a little bit more about this. Go ahead, Ben.
One of the things about the target date fund piece is that you used to be able to call in to the 401k company and they would give you an allocation based on what you're trying to do, whether your risk was moderate or conservative or aggressive, and they would, help you kind of come across your 5 or 8 or whatever funds that they would choose. Instead, now they've said, well, you know what? We're not getting paid enough for that, so we're going to create a target date fund, give everyone the exact same allocations we give over the phone, and we'll charge an extra fee. And if you're paying, more than 0.5% for those funds, like you're overpaying because they already have these funds underlying in their portfolio. Like they just took everything they were already doing for you, packaged it up in a story, and sold it to you. And they're doubled or tripled what they're making. And, there's more lawsuits out for these type of funds than I think. We did a show on this a long time ago, and I don't know what the statistic is still true, but more than almost any other mutual fund system out there. There's a reason for this. You can't put everybody into a bucket and say this is what you get, A, B, C, or D. And that's been a problem. And so the 401k space, and why we said, hey, 401k no more, it's not that it doesn't exist and it's not going to be part of your history and the free money that employer matches have. But if you're looking to really amplify and create a sound opportunity to retire, whether or if you are retired, and we're going to go through a flat decade or two, and if that's what your fear is, which it should be, because if that happens, you're going to sink, then you need to start doing some planning around that. And there's ways to do that. There's ways to, manipulate your 401k to be that way. So maybe you're looking at taxes and you're saying tax brackets aren't that bad. Maybe I won't only contribute up to the match that my employer's giving, and I'll take the money out, or I'll move the money to a Roth IRA piece inside the 401k for those dollars. But I'm 59.5, or I'm 60 or 65, or I have this old 401k that's not doing anything. I'm going to take that and I'm going to get some real control over that. I'm going to hire somebody, a financial planner. And we are financial planners. That's how we get paid. It's no different than anybody else, but I'm going to hire somebody to help me through what could be the flat decade or two, so that when I go ahead and hit that retirement button, I've got more than I would have if I just made nothing in my 401k. Because how many times you open up a statement, guys, we hear, I open up the statement, and Ben and I have sat with you, and every time I open up the statement, the reason I'm here is because this 401k never moves. It doesn't do anything. I mean, guys, how many times have we heard that? And that is, if you think like you're alone in that story as listening today, you're not. Get help. Why wouldn't you? If you're not making any money and that company's not helping you, get some help.
Yeah, I think one of the other stories that we hear a lot is, 401k is, it's moving forward. If I feel like I'm doing well, and then you just help people walk through the math of, well, those are the contributions you're making. Your account is growing by the money you just added to it, not much else. Right. So, anytime retirement funds accumulate and grow and move forward, we're always happy for that. Right. But there's this perspective that gets lost around, well, what's contribution and what's actually return on your investment. And those are two different numbers. So, some enlightenment, finds its way through when we kind of break that down for people. And the whole notion of the target date fund, as you're talking, Ben, it was just driving me crazy listening to this because, as financial planners, we have an obligation, rightfully so. I mean, this is how we do our work. But we need to offer advice that's tailored to people specifically. But it's got to fit their individual financial picture, considering their own personal risk tolerance, their investment experience, their time horizon, and their goals. We're obligated to offer advice only based on those things. But then you go into the 401k space and they ask you one question, oh, when do you want to retire? And then they jam everybody into that bucket, considering only that one factor. So that's not real planning. That's not real advice. That's not structured in a way that suits you based upon anything other than one simple question. When you sit down with us, there's going to be a lot more information that we try and get out of you so that we can properly design a plan.
The other thing is, too, Dan, as you're talking about this, we have that video of sequence of returns. We talk about it all the time. It's on our website. Go to BrayshawFinancial.com. Go to resources. Look at the video, sequence of returns. Because that's what we're really facing. People are basing all of their projected retirement off of a certain amount of history. But the truth is that history has now been changed. Like the future of this whole system is no longer what it was all designed off of. So we looked at the baby boomers and we looked at the 40 plus years of retirement that they have been doing, and in their investing, and then all of a sudden they were growing up in the 70s, 80s, 90s, right in there. All the baby boomers are investing dollar after dollar, and they're just in growth funds and growth funds and growth funds. And then all of a sudden they hit retirement and they say, I need value, I need stability, I need safety. And they switch all of their investments over to a totally different investment structure. And they're the ones that have the majority of the assets. And so when you start looking at that, you start saying to yourself, oh, well, now the money's moving to a different bucket. You don't want to be invested in the old bucket that everyone based their standards off of. And all of these portfolio standards are all based off of the history of how people made their money, not where they're going to move their money or new investments with their money. And so that's being lost in this whole system is we're providing this history of how to invest and applying it to moving forward. And the truth is that the world is not stagnant, and we have this huge baby boomer shift that's changing the investment landscape.
Yeah, we've got options. You guys, you have options. I think that's one of the main things we want to talk about. Speaking of options, if this is a conversation for you that's a little bit overwhelming, take a breath. All right? It's okay. It's all right. I want you to just understand that, first of all, we're not here to just scare you, okay? That's not the point. It's fake news. No, that's not what we're doing. We want to just make sure that inside of this, it's a conversation that you're able to have and understand a little bit more about your situation and your opportunities. Guess what? You can actually just reach out and call us. Okay, we do this regularly for our clients. And if you're a Money on Tap listener, we want to extend that invite to you as well. If you just need somebody to get on the phone with you and translate what in the world your 401k provider is talking to you about or what the offers are inside of that, some simple things can happen in that. You know, we can lower the blood pressure a little bit. We can make some decisions. We can try to have understanding. You're not necessarily signing up for the Money on Tap program or something like that. You're not making a lifelong commitment to Ben and Dan and Seth here. We're here to help. Okay. And we do that a lot with people because we want you to have success in your investing. Above everything else, that's what we're here for. And that's what we want for you, is to be successful in your investing. And that sometimes just requires us helping, people out or you asking for some help. And if this is a little bit of a startling conversation, well, and sometimes that's good. Sometimes I need somebody to, like my dad would say, kick me in the fanny, get me out there, play the game. Because, the game isn't played on the sidelines. It's in the field with you participating and being a part of your team or being on the court. To bring it back full circle to football, I was trying to see, do we have anything in here that we could kind of pull in some other people that maybe we got some golfers or some people playing tennis that we can, make this more palatable for? I got nothing.
I still don't understand why people play fantasy baseball. I'm still trying to figure that one out, though. This is a scary show. I mean, I get that. And I get people are saying to themselves, like, hey, what are they talking about with the 401k no more? It's just that you really need to empower yourself and grab hold of your 401k, get some help from someone like us or some other professional to help you maximize and deal with what's ahead, because there's a lot of real change coming and no one knows what it is, but you can't be stuck for the next 10 years not making money. You can't be stuck not having the ability to grow your retirement income so that you can actually stay retired and be retired.
Yeah, I mean, the notion of a flat market over that decade that trailed these similar economic conditions in the 70s, that's taking a look at the index, right? That's the S&P 500 that they're using as a peg that, led to this flat 10-year period. But inside of that, there were sectors that performed for given periods of time. And that's what we're talking about, the active management. Look for those emerging market opportunities. Look for those value funds, value stocks. Looking for, small cap type of opportunities. So in that larger space of the S&P 500, there were groups of stocks at different intervals that performed well. And professional advising can help you target those things and find them.
Thanks for joining us today. You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. That's going to do it for 401k No More. Be successful in your investing, and we cannot wait to meet you here next week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.